Hello, I am Wael Yahya, Certified Financial Technician Expert from the International Federation of Technical Analysts. In this video, we will apply the classical technical analysis view over all time frames to answer a difficult question, which is it the end of the uptrend for the oil? As usual, let us see the general market structure over the monthly chart. First of all, we will notice that the historical high was around the $150 area. Of course, we are talking about areas and zones, not just clear-cut levels. So this is an area that we will say in just a minute that it is very thick, more than you could imagine. So this is the historical high around $150, and we do have a kind of very important monthly support around the $27 area. And here you can notice that we do have one bottom above $27, another bottom exactly at $27, and the third one was having a volatile shadow below the $27. So I chose to draw the middle one because I will consider an area of $10 thickness above the 27 and an area of $20 another $10 thickness below the 27. So this is a very thick band of support. The same applies to the resistance. If we took into consideration this level of $127, which formed a giant long-term peak around it or just below it, so I may consider that this zone of $20 thickness is considered a very reddish, negative, bearish zone with sellers accumulating around that range, which is $20 thickness, maybe a little bit more. So and this is acceptable because a $10 thickness range around 27, it is doubled around 150, and this is accepted and logic because here the price is much higher, so the thickness is. Okay, this was an introduction just in order to tell you that the oil is moving in a giant trading range for 14 years approximately, since the financial crisis in 2008 through 2018. Here are 10 years, and now we are almost half 2022, so it's approximately 14 and on the way to make it 15 years of a trading range. This monthly trading range is consisted of long-term trends, and we will check this over the weekly chart. The long-term trends that consist the waves within the monthly trading range are as follows. Here it goes down, reflecting from the major resistance around 147, and here it reflects or bounces from the support or near from the support, the monthly support around $27. So this is a trend, this is another trend. Medium term, approximately, sometimes long term, it's ranging from 1.5 to 2 years, and here is sometimes it goes into long-term consolidation sideways. So here it went downtrend, here it bounced from the support, it didn't complete the cycle. We can see it did not complete the expected cycle, but it reflected from another major resistance, monthly one, around the $90 mark, and it went downtrend. Now the last test of 27 resulted in a new uptrend that managed to reach the resistance around 127. So it is expected and logic to think that the oil will be in a new major downtrend to complete the cycle, to complete its habit of performing different trends, from reflecting from resistances or bouncing from supports, as it always did in the last 14 years. So over the last 14 years, this is considered logic, and it is not surprising that we do expect a new weekly long-term trend reflecting from the major resistance around 127. If we take a look at the trend, we can see it is clearly up, at least until now. So we here are connecting the higher lows and the channel line connecting the higher highs, as we can see here. 1, 2, 3. So it looks like there is a kind of reversal pattern in the formation process, which I guess it may be a double top with a neckline running through the $100 mark, which is also considered a psychological level of support. If this pattern completed and the break of the neckline is valid and confirmed, I think this trend will be broken and it will not be an uptrend anymore. Mostly it will be a downtrend. In the best of cases, it may get stuck into a trading range over the weekly, but it will not continue as an uptrend as it was since the start of 2021. So what constitutes a valid break of this pattern in order to say it is completed? I think this will require us to check the daily chart for the short-term details. Here we go. We can see here much more details. Here is the expected double top. It is not completed yet. We need a break, a valid break below 98 level, and on closing basis, it is preferred to be weekly closing basis. It's better to be 2 weeks close below the 98 level. 2 weeks close below that level will confirm the break and will signal the completing of the double top as a reversal pattern. The thickness of this pattern ranging from the neckline at 98 up to the common resistance over the weekly around 124. This means that we do have approximately $25 thickness of this reversal pattern, which will be subtracted from the level of the break, meaning that we are targeting approximately $25 to the downside, which means that we are targeting $73 over the medium term in case of a confirmed valid break below the neckline. What adds to the negativity and to the bearish outlook of the oil is that it is over the short-term move. It also formed a downtrend over the daily chart consisting of lower highs as well as lower lows, and it was easily drawn a downtrend line as well as a down channel line. As you can notice, Here is the neckline of the expected double top, and any break, as we said, is negative. A closing on daily or weekly basis, more negativity. 2 weeks close is a confirmed signal to the downside. That's it for the oil. In order to gain some positivity, which is not likely to take place, the oil should always manage to close above the critical level of 98 in order to try to keep the trading range over the short term intact. But if it broke below the neckline, the bearish environment will be a reality, and the downtrend and its lower targets are more likely to take place. Thank you for watching. Please feel free to like, share, and subscribe, and see you soon.